Countries could be classified based on their level of economic development into three distinct categories, and that is underdeveloped countries, developing countries, and developed countries, depending on their level of economic development and probably technological advancement as well. So I want to talk about futures of emerging markets. Emerging markets here refers to the characteristics that defines economies or countries that are transitioning from developing to a more developed or industrialized system. That's transition, countries transiting from a stage of a developing economy to an industrialized or developed economy. And so here are key features of emerging markets. So in this case, I want to talk about what makes emerging markets unique and the key features investors need to be familiar with. Number one here is high growth potentials. Emerging markets have an extraordinary potential for high growth. So they often experience rapid economic growth driven by industrialization, urbanization, and rising consumer demands. And so this presents significant opportunities for businesses and investors as these economies tend to expand at a faster than normal rate. The economies there tend to they grow faster, they expand faster than that of a typical developed economy or developed countries. There's that high growth potential. Number two is market volatility. Market volatility. These markets or these economies or these countries are generally more volatile than developed ones, with political instability. Is very common, it's a very common characteristic of an emerging market. You talk about currency fluctuations. They float their currency more often than, should I say, more often than necessary. And investors, may be harmed in the process. And not only that, their reliance on export, contributing to unpredictability. They are like consumer nations. They are so much they rely so much on exports. They export their goods and services, and in a case where there is a hiccup in the export process, then the economy will suffer tremendously. All right, and they are somewhat unpredictable. Number three is lower income levels. So income levels in emerging markets are typically lower than what is obtainable in developed countries. However, as these economies develop, a growing middle class, there's that growth in the middle class, which translates into increased consumer spending and demands for goods and services. A major characteristic of an emerging market is the emerging middle class. The middle class becomes prosperous, and by so doing, they tend to spend much money, much income on goods and services. Number four is developing financial systems. There's developing financial systems. Financial markets in emerging economies are often less mature and regulated compared to developed markets, leading to higher investment risk, but also the potential for higher returns. And so the overall financial system is isn't as mature as what is obtainable in developed countries. They are still in the developmental stage, and that comes with a level of risk attached. But with that risk also comes a potential for high rewards. It's left for the investors to be able to balance the risk and of course the expected reward. Please subscribe to this channel. If you've not done that, like this video and drop a comment in the comment section. Number 5 is resource richness. There's resource. They are rich in resources, resource richness. So many emerging markets are rich in natural resources such as oil, minerals, as well as some agricultural products. Typical examples are African countries, and Nigeria is is a very good example in this context. We have crude oil, we have other mineral resources, gold, name them, as well as various kinds of agricultural products. These resources attract foreign investments, but can make economies vulnerable to commodity price fluctuations. If we are so reliant on export, we export crude oil, we export agricultural produce. Well, that is a good development. But in the case where there is currency fluctuation, then of course we may not be able to attract uh, you know, uh, attract a good price in the international markets for the products and services we are exporting. And that is, a typical disadvantage we should consider, a feature we need to consider when it comes to emerging market investments. But we should not forget that, with the inherent risk comes a high potential for an outsized level of returns. Number 6 is young and growing population. Young and growing populations. So these markets often have younger populations, which drive labor force growth and boost demands for housing, education, and consumer goods, providing long-term growth potential. For the fact that a larger population, a larger ratio or percentage of the population is young, compared to the elderly, you discover that there will be, a disproportionate demand for housing. That's for young families, for education. People need to get enlightened, need to get educated, and there's also an increased demand for consumer goods, which tends to provide a long-term growth potential. So that growth potential is what stimulates the economy and make emerging markets an attractive candidates, for foreign investors. I was watching a program on YouTube, I think yesterday. A particular individual is a very rich investor. He was talking about the fact that emerging markets, that Africa is where money or wealth will be created in the year 2025. He was so emphatic about it because he understands the potentials of investing in emerging markets. Number 7 is structural reforms. Structural reforms. Emerging markets frequently undergo economic and political reforms, such as trade liberalization, infrastructure development, as well as legal system improvement. When it comes to legal system improvement, discover that I think some weeks back or so, a new law was promulgated, law regulating securities and investment in Nigeria was signed into law. That's a new law. Not only that, we have infrastructure development like the coastal road, and also we have this trade liberalization as what is obtainable in the ECOWAS setting, nowadays. These reforms attract foreign investments and support sustained growth. Whenever there's positive reforms in the economy, it tends to attract foreign investments, and as foreign investors come in, the more the economy does better, and even the stock market is not left out. The stock market will equally benefit from they heighten positive economic activities. And so emerging markets offer both high risk and high rewards, making them appealing to investors who are prepared to navigate the associated challenges, for potential long-term gains. The risk actually, the risk is quite high, but we should not forget the fact that the reward is also very high. Usually, if you look at stock market performance in countries, you discover that the emerging markets are doing, very well actually compared to some growth or industrialized economy. And so, as an investor, you need to consider investing in an emerging economy. Maybe in Nigeria, thank God, our economy is an emerging one. That's why I like and I love investing in Nigeria, because the rate at which our stocks tend to appreciate compared to developed countries. You can still identify bargains because of the level of inefficiency in the market compared to developed countries where you can hardly ever come across bargains. The system there is so attuned to discovering and making use of bargains, and so they are very difficult to come by. Please invest in the country. If you're a Nigerian, don't be in a rush to invest outside. Invest in the country, and the returns will be quite palatable.